Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at Envirotech Vehicles.
If you find our talks useful, please consider subscribe, like, and comment underneath. Our mission today is to really get to the bottom of how this company's stock surged over 400%.
And, more importantly, what hurdles it still has to clear. Because with Envirotech Vehicles, or EVTV, you almost have to, forget everything you thought you knew about them just a few months ago.
Okay, let's unpack this. So to get the full picture, we have to start with the before. What was this company's traditional business?
Well, they operated squarely in the electric commercial vehicle market. They were focused on zero-emission vehicles, but for institutional fleets.
So not consumer cars?
No, not at all.
Yeah.
Think bigger, more specialized. We're talking Class 4 vans, urban delivery trucks, school buses, even really niche things like forklifts and street sweepers.
And they sold the whole package, the vehicle and the service.
Exactly. The vehicle plus maintenance plus inspection services. It's a whole ecosystem for commercial fleets and public transport.
That sounds like a solid business on paper, but I'm guessing the reality was a bit different.
A bit different is, putting it mildly, it's incredibly difficult. You have these long sales cycles, complex regulations.
And it's capital intensive, right?
Hugely. High fixed costs, long R&D cycles. And all of that led to, well, consistent losses. Their profit margins were just getting crushed quarter after quarter. They were stuck at a low margin grind.
Which brings us to the pivot, the moment that completely changed the story for this stock.
What's fascinating here is just how fast and honestly how audacious the shift was. They announced a merger with AZIO AI.
AI, that is a left turn.
A complete 180. AZIO AI specializes in data centers and high-performance computing. And that merger was valued at, get this, $480 million at $3 a share.
Wow. Okay, so that re-rates the entire business overnight. But an announcement is one thing. What was the real catalyst?
The real game changer was the revenue that came with it. Almost immediately, they announced a binding $107 million contract for NVIDIA B300 GPUs.
$107 million.
Binding, secured from a Southeast Asian government. So overnight, EVTV, or I guess the new AZIO part of it, becomes a key supplier in the global AI infrastructure build-out.
A contract of that size compared to their old revenue must be just dizzying, and there's more in the pipeline.
The sources mentioned a potential $200 million pipeline right behind it. This is why the market reacted. It's not just new revenue, it's high-margin revenue that offers an immediate turnaround.
So the thinking is, why struggle to sell electric street sweepers for a tiny profit when you can sell NVIDIA's latest GPUs to governments for huge margins?
That's it, exactly. It completely changes their financial profile and lets them focus on strengthening the balance sheet instead of just chasing low-margin EV sales.
But before anyone could really buy into this new AI story, they had to prove the old business wasn't going to drag them under. So let's talk about that balance sheet cleanup. What did they do?
They were very smart about it, a multi-step operation. First, they fully repaid $2.85 million in convertible notes.
Which is huge. Getting rid of convertible debt removes that, that overhang that can really weigh on a stock price.
Right. It takes a major uncertainty off the table. That was step one. Step two was raising cash. They raised $3.1 million through an equity issuance.
Now, some people hear equity issuance and they just think dilution, but this sounds like it was necessary.
Oh, it was strategically critical. By paying down debt and raising that cash, they pushed their stockholders' equity above NASDAQ's $2.5 million requirement.
So this was about compliance and stability.
Yes. It's a huge signal to the market that they're serious, that they're cleaning house to build a stable foundation for this new AI business.
And that cash is going right back into the business, I assume.
Correct. The sources were clear. It's being reinvested into the transformation. No buybacks, no dividends, all focuses on the pivot.
So they've stabilized the financials, they've pivoted into the hottest sector on the planet. What's their edge? What's their competitive moat now?
If we connect this to the bigger picture, it's really interesting. They kind of have a dual moat now, which is pretty rare.
Okay, what's the first one?
The first one is the legacy moat. It's still valuable. They have established manufacturing and existing customers for those really specialized EVs.
Like what kind of specializations?
Think right-hand drive vans for certain markets.
Yeah.
Or trucks with custom fits for urban delivery. Things that create really high switching costs for their existing fleet customers. You can't just swap those out easily.
So the EV business, while not a huge moneymaker, provides a sticky customer base.
Precisely. And then you have the second, much more exciting moat, which is the post-merger AI business. They now have this exclusive access to high-value NVIDIA GPU contracts.
Which none of their old EV competitors have.
Not even close. It completely differentiates them from the pure EV players who are just struggling with their own capital expenditures. They've basically bolted a high-growth, high-margin tech business onto a stable, albeit slow, manufacturing base.
A very clever defensive layer. It insulates them from the risks that every other small EV company is facing.
It makes the whole investment thesis much, much more robust.
Here's where it gets really interesting, though. The market reaction. I mean, the price action that followed all this news was just explosive.
It was incredible. After the merger and GPU contract news dropped, the stock surged 442%.
442.
Yes. And we saw signals even before that. There were these 213% and 135% intraday gains. I mean, can you imagine holding the stock through that? It was a complete re-rating.
Numbers like that signal more than just growth. It's a massive breakout. It's the market completely repositioning the company as an AI player first, EV maker second.
That psychological shift is everything. And it wasn't just retail investors. We saw huge volume surges along with the price spikes. That suggests institutional money was flowing in, confirming the trend.
But after a run like that, I mean, 442% is astronomical. You have to ask, isn't there a risk that it's just overheated?
That is the crucial short-term question. And yes, technically it absolutely hit overbought conditions. The Relative Strength Index, the RSI, was cited at 82.34.
And anything over 70 is usually considered overbought.
Exactly. So 82.34 is pretty hot. It suggests that some short-term volatility, maybe a little cooling off period, would not be a surprise at all.
So the technicals are flashing a bit of a warning sign for the short term.
A little bit. But if you balance that with the overall sentiment from the data analysis, the mood is still overwhelmingly positive.
What's the data say?
The weighted sentiment score is around 0.41, which is firmly in the strongly bullish camp. And what's really telling is that it's all being driven by the recent news, the debt repayment, the equity raise, and of course that NVIDIA contract.
And no one is really talking about the old problems anymore.
Not in the recent top articles, no.
Yeah.
There's a complete lack of fresh bearish commentary. The entire narrative has flipped.
And that narrative all comes down to execution now, which means there's a specific date on the calendar we all need to be watching. What's the big catalyst?
January 20, 2026. That is the date.
And what happens then?
That's the shareholder meeting to vote on the AZIO merger. Now, remember, the deal is technically non-binding until that vote happens. If shareholders approve it, it solidifies this entire transformation. It's the key catalyst.
And this is all happening with some pretty powerful macro trends at their back.
For sure. You have the AI infrastructure boom, where demand for NVIDIA's chips is just insatiable. And you still have the regulatory tailwinds for EVs pushing fleets to go green. It's a great environment for both sides of their business.
But we have to look at the other side. This raises an important question. What could actually derail this? What are the big risks here?
There are two primary risks. The first is obvious: merger execution.
The deal fails at the shareholder vote.
Exactly. The deal is non-binding. If it fails, it could be catastrophic for the stock price. I mean, you have to remember, this stock was down over 75% in the past year before this news. A failure would erase these recent gains very, very quickly.
That's a scary thought. But the analysis suggested this risk is manageable. Why?
Because of that binding contract. The $107 million NVIDIA deal is already locked in. It's a real asset generating real high-margin revenue. So even if the larger merger hits a snag, the most valuable piece of the puzzle is already secured. That makes a total collapse less likely.
Okay, that makes sense. What's the second risk? Does the ghost of the old, unprofitable business still haunt them?
It absolutely does. Risk number two is that legacy financial weakness. The fact is, they still have negative earnings per share and low revenue from the EV operations. That's a drag on the books.
And some analysts are still focused on that, right?
Right. There was a make a C plus hold rating mentioned, with a target of $1.11. That rating reflects the pre-pivot skepticism. If the AI plan stumbles, they fall back on that weak foundation.
So why is that risk considered priced in?
Because the entire story has changed. The deleveraging and the NASDAQ compliance fixed the immediate survival threat, and the AI pivot gives them a credible path to profitability that just didn't exist 6 months ago. The market isn't trading them on EV sales anymore. It's trading them on AI infrastructure potential.
So what does this all mean? If you had to put it in an elevator pitch, what's the final synthesis here?
Envirotech Vehicles has pulled off a radical pivot. They've gone from a struggling low-margin EV maker to an emerging AI infrastructure player. The $480 million AZIO merger, backed by a real $107 million NVIDIA contract, makes it happen. The stock's massive surge is the market buying into this new identity, and the January 20th vote is the final seal of approval.
So based on all that, the fundamentals, the technicals, the risks, what's the final score?
We're assigning a bullish score of 8 out of 10.
And for anyone watching this, what's the timeline? Is this a quick trade or a longer hold?
It's a bit of a two-step process. Given the big vote coming up, you could see it as a swing trade into that January 20th event. But after that, assuming it passes, this becomes a multi-quarter hold. You'll need that time for the high-margin AI revenue to really hit the books and transform the company's financials.
That makes perfect sense. So here's a final thought for you to consider. Given this explosive reaction from the market, and with those global pressures pushing commercial fleets toward EVs anyway, how quickly will the market fully decouple the valuation of this new AI business from the legacy vehicle business? Will bad news about EV sales ever matter to this stock again, or is it permanently an AI play now?
That decoupling is the multi-million-dollar question, isn't it? That's what makes this story so fascinating to watch.
Thank you for the analysis. We'll be back tomorrow with another opportunity.